It's always a moment of truth when a company releases its earnings, isn't it? The market just hangs on every number, trying to figure out the story behind the financials and, well, what it all means for the stock.
Absolutely. And for a big player like Tesla, a key piece of that puzzle is the Form 10Q. That's their quarterly report. And it gives you a really detailed look under the hood, so to speak, at their performance.
Exactly. We have got Tesla's 10Q right here for the quarter ending March 31st, 2025. And this isn't just, a quick summary. Our mission today is to really dissect this thing from an investor's viewpoint. We want to pinpoint the data, the trends, the stuff that would actually move the needle on how someone values Tesla shares, finding the insights that truly matter.
Okay, sounds good.
Mhm.
So let's dive into the overall financial picture for Q1 2025. Where do you want to start? What jumps out at you first?
Well, the top line is always the first stop for me, and it's showing a decrease. Total revenues for those first 3 months of 2025, $19.34 billion, which is down about $1.97 billion from the $21.3 billion they did in the same period last year. That kind of dip, well, it definitely raises some eyebrows for
It
investors.
does, yeah. Nearly $2 billion is significant. And that kind of revenue trend, it flows directly down the income statement,
Hmm.
net income attributable to common stockholders. That also saw a really substantial drop.
How much?
It fell to $409 million
Mm.
in Q1 2025. Compare that to $1.39 billion in Q1 2024. So that's a decrease of almost $1 billion. Investors are always very sensitive to shifts in both revenue and profit.
No doubt. But it's interesting. It's not all pointing down. Their cash positions, so cash equivalents and investments that actually grew.
Well, right.
Yeah, it reached $37 billion at the end of March 2025. That's up $433 million just since the end of 2024. So they're actually sitting on a bigger pile of cash. What do you think an investor makes of that? Does it signal anything about, say, their investment plans?
Well, that's a key question, isn't it? Having strong cash reserves gives you flexibility, security. It
Mhm.
means you can potentially weather economic storms better or, fund future strategic moves.
Right.
And if you look at their cash flow statement, there's another really interesting point. Cash flows from operating activities. They jumped significantly
How much?
to $2.16 billion in Q1 2025. That's way up from just $242 million in the same quarter last year.
Wow. Okay.
So that's a pretty dramatic improvement in the cash they're actually generating from just running the business day to day.
That is a big jump in operating cash flow. Okay, so if they're generating more cash from operations, where is it going? It's interesting because capital expenditures they're spending on big projects actually went down quite a bit, actually.
How much?
They spent $1.49 billion in Q1 2025, which is way lower than the $2.78 billion they spent in Q1 2024.
Huh. So generating more cash, spending less on CapEx.
Yeah, what could be driving that? And how would an investor read that? Is it like efficiency? Or maybe they're being more cautious about expansion right now?
That's exactly the kind of question an investor would be wrestling with. A drop in CapEx could mean they're, getting more out of their existing factories, or maybe they're pulling back slightly on major new projects.
Right.
Depending on their strategy and how they see the market, you could view it as prudent cost control or maybe a potential sign of slowing expansion. It depends on context.
Okay, let's maybe dig a bit deeper into the segments because Tesla obviously isn't just about cars anymore.
Correct. Though let's start with automotive since it's still the main engine. The numbers here pretty much reflect that overall revenue decrease we already talked about.
Right. So automotive sales revenue, just selling the cars, saw a big drop, $12.925 billion in Q1 2025, down from $16.460 billion a year ago. That's a big hit. What's behind that, do you think? And what worries might that raise for investors focused on, volume growth?
Well, several things could be in the mix. Pricing changes, maybe shifts in demand in certain countries, perhaps production adjustments. For investors, yeah, a significant drop like that immediately flags concerns about the growth story, about competition.
Makes sense.
But it's worth noting, their revenue from automotive regulatory credits actually went up.
Ah, the credits they sell.
Exactly. Those rose to $595 million in Q1 25, up from $442 million the year before.
Yeah.
So those credits, which they get for selling zero-emission cars and can sell to other automakers, they do provide a nice little buffer against some of that sales revenue decline.
Yeah, they certainly help the bottom line. And automotive leasing revenue also down slightly, $447 million this year versus $476 million last year.
Okay.
So yeah, across the whole automotive segment, total revenues are down $13.967 billion this Q1 compared to $17.378 billion last Q1. And that obviously hits their automotive gross profit.
Undeniably. Automotive gross profit fell to $2.368 billion in Q1 2025, down from $3.293 billion the year before. That drop directly impacts their margins for the core business, which is, a key metric investors watch like a hawk to gauge efficiency and pricing power.
Okay, definitely a challenging picture in automotive right now. But let's pivot to the other segments. Energy generation and storage that looks like a real standout performer in this report.
It really is a bright spot, yeah. Revenue in energy jumped significantly. It hit $2.730 billion in Q1 2025.
Wow, compared to...
Compared to $1.635 billion in Q1 2024. That kind of growth, in a non-car part of the business, that could signal a successful diversification that investors might really like to see.
And it wasn't just revenue, right? Their gross profit in energy also shot up from $403 million last year to $785 million this year.
That's right. So it's not just growing fast, it's becoming much more profitable too.
Could this energy side become like a much bigger part of the whole Tesla investment story going forward?
I think absolutely. Having a highly profitable, growing energy segment can definitely help offset bumps in the automotive road. It presents a more compelling, broader growth story for investors looking beyond just vehicle sales. Makes the company look less dependent on one thing.
Yeah, diversification. And what about services and other? How did that do?
That segment also showed some positive movement. Revenue there increased to $2.638 billion in Q1 25, up from $2.288 billion the year before.
Okay.
So maybe not quite as dramatic as the energy growth, but consistent growth there also helps the overall financial picture, adds stability.
Okay, so definitely a mixed bag across the segments. Now, let's really zero in on some specific data points from this 10Q that would, directly influence how investors are thinking about the share price itself. Let's start with production versus deliveries.
Always a crucial one. It's a key indicator of demand, essentially. So in Q1 2025, Tesla delivered about 337,000 consumer vehicles.
Okay.
But they produced around 363,000.
Ah, so they made more than they sold.
Exactly. That difference, roughly 26,000 vehicles, means their inventory levels went up. Investors watch this metric very closely. Does it signal demand might be softening? Or is it just a temporary blip due to production schedules?
Right, because growing inventory could mean they have to cut prices later to move those cars, which hurts margins.
Precisely. It can put pressure on future pricing and profitability.
Okay, and sticking with that theme of demand and profit, let's look at the cost side. Cost of revenues, overall gross margin. We know overall gross profit was down, but any specifics within the cost of goods sold that caught your eye?
Yes, actually, the report specifically calls out increased write-downs of inventory.
Write-downs, meaning?
Meaning they had to mark down the value of some of the cars they were holding. In Q1 2025, these write-downs were $79 million. That's up quite a bit from $39 million in Q1 2024.
So nearly double. What does that tell you?
It suggests some inventory might be losing value faster, maybe because it's not selling quickly, or maybe due to product updates making older stock less desirable. Either way, it can hurt profitability and make investors a bit nervous. Could also mean they had to offer discounts.
Yeah, that makes sense. Okay, shifting gears slightly to the operational side, operating expenses. What's happening there?
Research and development, R&D, saw a pretty noticeable increase. It rose to $1.409 billion in Q1 2025, up from $1.151 billion the year before.
So spending more on R&D, how do investors typically view that?
It's often seen as a positive, actually. Even though higher R&D spending hits current earnings, investors tend to view it as an investment in the future. Innovation, new products, staying ahead.
But there's a catch, right?
Well, yeah. They'll want to see a clear path from that spending to actual products and revenue down the line. It can't just be spending for spending's sake.
Absolutely. It's that classic trade-off, short-term profit versus long-term potential. Now let's look at where Tesla is making its money geographically. Any interesting shifts there?
Yeah, the geographic breakdown does show some notable changes. Revenue from China was down slightly, $4.303 billion this Q1 versus $4.592 billion last Q1.
Okay, a small dip in China.
But the other international markets,
Yeah.
so everywhere else outside the U.S. and China, that saw a much bigger drop.
How big?
Fell from $6.947 billion down to $4.699 billion. That's a pretty significant decline in those international markets. Investors will definitely be looking closer at that.
Over $2 billion less. Wow. But on the flip side, the U.S. actually grew.
It did. Revenue for the United States increased. Went from $9.762 billion in Q1 2024 to $10.3333 billion in Q1 2025. So it looks like the U.S. market is becoming, relatively speaking, an even stronger driver for them.
Interesting. So more reliant on the U.S. market now. How might investors view that concentration, good or bad?
It's a bit of both, really. Strength in your home market is obviously good, but relying more heavily on one market also increases risk. Investors might worry about growth potential elsewhere or exposure to any U.S.-specific economic downturns or regulatory shifts. Diversification is generally preferred.
Okay, let's talk deferred revenue. This is money they've collected but haven't booked as revenue yet, right? Gives
Yeah.
us a peek into future earnings.
Exactly. For the automotive segment, think about things like full self-driving or FSD supervised, as they call it now, and other software features people pay for upfront. The total deferred revenue there was $3.60 billion at the end of March.
And how much of that do they expect to actually count as revenue soon?
They anticipate recognizing $780 million of that within the next 12 months. So it provides some visibility into that near-term software revenue stream.
Okay, $780 million coming in from auto software. What about the energy side? Does deferred revenue matter there?
Oh, absolutely. And it's quite significant. The energy generation and storage segment had $2.09 billion in deferred revenue at quarter end.
Okay.
But here's the interesting part. They expect to recognize a much larger amount, $4.71 billion, as revenue in the next 12 months from their longer-term energy contracts.
Whoa, $4.7 million. That's huge for the energy business.
It is. That strong near-term revenue recognition potential in energy is a really positive signal for investors looking at that segment's growth.
Definitely a key area to watch. Now, just quickly, what about their overall financial stability? Debt levels, access to cash.
The report suggests pretty stable debt levels, which is always reassuring. And importantly, they managed to refinance their big working capital facility in China, extending it out to April 2028.
So no immediate pressure there.
Right. Takes that off the table for a while. And combine that with the strong cash position we talked about earlier, that $37 billion Tesla seems to be in a very solid liquidity position. Gives them a good buffer and firepower for future investments.
Yeah, that strong cash balance really does seem like a major plus in their overall financial health right now. Okay, so the 10Q is mostly numbers, but it also touches on risks, right? Legal stuff, regulations, investors always factor that in.
They do. And the report mentions the ongoing legal battle over the 2018 CEO Performance Award, Elon Musk's pay package, that's currently being appealed. That represents a notable legal uncertainty. The outcome of high-profile cases like that can definitely sway investor sentiment and could even have financial implications depending on how it ultimately plays out.
Absolutely. Legal clouds can create risk. What about supply chain and production? Any updates there?
They mentioned the ongoing production line changes for the new Model Y,
Yeah.
happening across different factories simultaneously.
Aimed at improvement, presumably.
Yeah, the goal is better efficiency, maybe paving the way for new models eventually. But transitions like that always carry risks, potential for temporary shutdowns or delays.
Yeah.
And they also acknowledge the usual suspects. Continued uncertainties around global supply chains, potential impacts from trade policies. Those external factors can always affect costs and production timelines.
Okay. And finally, just zooming out a bit, the broader economy, the market itself for EVs and energy.
Yeah, the report acknowledges that the car industry is sensitive to things like interest rates and inflation,
Yeah.
which obviously affect whether people buy big-ticket items like cars.
Especially now.
Especially now. And they also point to increasing competition in the EV space. More players are jumping in. These kinds of external pressures, they definitely get factored into how investors assess Tesla's future prospects for growth and profit.
Okay, so we've really gone through the weeds on the key financial data and trends in this latest 10Q. It definitely paints a pretty nuanced picture, doesn't it?
It really does.
You've got a company facing some clear headwinds in its core automotive business, but at the same time showing real strength and significant growth in energy and still sitting on a very solid financial foundation.
Precisely. And those mixed signals are exactly what investors have to grapple with. The dip in auto revenue and net income, that's going to be a concern, no doubt.
Yeah.
But then you balance that against the really strong growth and improving profit in the energy segment, that huge cash pile, the continued R&D spending.
Yeah.
It suggests a more complex, maybe evolving investment case for Tesla. It's not a simple story right now. It requires careful weighing.
So as we wrap up this deep dive, maybe here's the big question for you, the listener, to think about. How will Tesla manage this balancing act? How do they navigate the current pressures in automotive while capitalizing on the massive opportunities in energy and autonomy and with their next-gen vehicles.
Yeah.
It's a really complex challenge, and how they handle it will have huge implications for the company's future value.
That's the fundamental question, absolutely. And we'd really encourage you, if you're interested, to dig into the full 10Q report yourself. Get that deeper understanding of these trends, put them in context with the wider market and Tesla's own long-term plans. That's where the real insights lie.